Welcome back to Weekly. Joining me now to chat about the economy in 2020 is David Rosenberg, the chief economist and strategist at Gluskin Sheff. Thanks for coming back onto Weekly, David.
Thanks for the invite, Andrew.
So I know several issues caused you to be quite circumspect at the bullish U.S. jobs data last week, or at least that's the way markets took the data. And when reviewing the equation for GDP growth, consumption plus investment, plus government spending, plus net trade, in looking at the states, only the letter C is working at this point in time, consumption. And I agree that consumption growth is slowing down in the back half of 19 and will continue to do so in the front half of 2020. But I still get the sense that, at least for the first half of 2020, consumption can enable the U.S. economy to continue to grow at, call it 1.5% on an annualized basis. You agree or you disagree with that?
Well, I think that 1.5% is more or less a consensus type of forecast. And if you believe that potential GDP growth is, say, closer to 2, you're still going to get more disinflation pressure. The unemployment rate's going to stop going down, it'll go up. And, 1.5%, when I started in the business in the mid-'80s, when you got to like 1.5% growth, which I guess people today marvel at, we used to call it stall speed. When you got to 1.5% growth decades ago, you'd be thinking about, well, when's the recession going to start? And today people are jubilant when they hear 1.5% growth. I think that it's going to be weaker. I still think that recession risks are elevated. And in fact, what's interesting is that when you go to the New York Fed recession model, it's as high today, it's call it roughly 50%. Now it's down from 80, where it was in August at the peak. Interestingly enough, recession odds are actually the same today that they were a year ago. And the stock market's 25% higher.
Right.
But the point that you make is an appropriate one. The consumer, 70% of GDP, half of that 70%, call it 35% of U.S. GDP, never goes down in a recession. Because think, when you're talking about the consumers hanging on, think of what consumers spend money on. They spend money on rent. They spend money on utilities. They spend money on healthcare. They spend money on education. Those four things are half of consumer spending. And they never go down in a recession. In fact, those things didn't go down in the 08-09 Great Recession. So you can understand, to get an actual GDP recession, all the other things in the economy have to go down by quite a bit. So when you're talking about, for example, well, the consumer is hanging on in the aggregate, that much is true, because they're not cutting back on the essentials of life. But we got the retail sales number, for example, and for November. And what's interesting is that when you look at the cyclically sensitive parts of spending, not the necessities, not the pharmaceuticals, not the clothing, restaurants were down again. When you're taking a look at the stuff that we want but don't need, so we're talking about the cyclically sensitive parts of retail sales. Well, they're running negative over the past 3 months. And what you're seeing is a more defensive tilt. And that's what happens in the consumer right now that I'm noticing, is that there's a more defensive, shall we say, consumer staple bias going on, even though consumer spending isn't declining outright. But I'll say this much. I do think that the components of GDP and the economy don't operate in a vacuum. You don't go through a capital spending recession like we did in the U.S. and not have a lagged impact on employment. And I think that's going to come next. That's why I think your 1.5% might be off base, is that we haven't seen the lagged impacts of we had rolling recessions in the past, not just 12 months, 18 months. We had a recession in housing in the United States. People don't even know that in the national account data, housing has been negative for 6 of the past 7 quarters. And that's a quintessential leading indicator. We had downturn in commercial construction. We know for a fact there was a downturn in business investment. And look what exports have been doing over the course of the past half year. Now we'll see, maybe this trade deal over soybeans turns things around. I'm quite skeptical on that. But you see, all these things have a lagged impact on other parts of GDP. Okay, the economy is like a living thing. It's an organism. So I actually think that we're going to have more problems for this so-called resilient U.S. consumer next year than what's currently priced in.
Right. So, but does it drop off the cliff in the second half of the year as it gradually declines during the front half? Or do you see problems sooner than that in the U.S. economy?
I think that, well, nothing's going to fall off a cliff. Okay, so I'll make that point right now. But you come back, for example, to what you said about the non-farm payroll report. Now, I saw a lot of non-ratification in that payroll report, and I actually found that there was a lot of growth in very low value-added industries.
Right.
I mean, waste management, leisure hospitality, health.
Low-paying jobs.
Low-paying jobs. And just like the retail sales numbers, all the growth are in areas of the economy that actually are non-cyclical, which is very interesting.
Right.
But if you believe, and I think most economists do, everybody was just marveling over last week's non-farm payroll report. If you actually believe those numbers, you have to believe that productivity is declining at roughly a 1.5% annual rate. By the way, after the fractional negative in the third quarter, so people say, well, there's no recession in GDP. Well, I got news for you. We've had a recession in corporate profits all year long, and there is a recession in productivity. Productivity is going down if you believe those numbers, which tells you what, as an employer? It's telling you that you have overstaffed. There's going to be a price to be paid for the second half weakening in productivity. Of course, not being reflected in the stock market for a whole range of reasons. The stock market long ago stopped being an economic barometer. But productivity declining means this, that companies are going to rationalize on labor in 2020. That's going to come back to a rising unemployment rate, receding wage growth, and the consumer is going to slow down. I'm going to say that, no, not the 50% of consumer spending that is devoted towards rent and food. That's not going to go down. But the stuff that's dedicated towards, luxury goods and services, those are the areas in the market I'd be avoiding next year.
So what about the consumer balance sheet in the States? We see that the aggregate data is in decent shape, but if you quintile it, is the U.S. consumer in better shape from a financial perspective?
Well, Iso, that is that's the narrative that you hear, because this cycle has been a deleveraging cycle.
But the top quintile is clearly rocking, right? What about the middle and lower deciles and quintiles?
Well, of course, they're in a much greater stress and disarray, and they didn't benefit from the equity wealth effect that the higher wealth or higher income echelons did. But let's just look at the aggregate data, and the point I'm making is this. People say, oh, well, look at U.S. household debt to income ratio. It's come down from its peak of, say, 12 years ago. That much is true. But the U.S. household debt to income ratio is the highest it's ever been for this stage of the cycle, in every cycle in post-World War II history outside of 2007. So, if you like to compare U.S. household balance sheets to the credit bubble peak, what we call the mother of all credit bubbles in 07, if that's what your benchmark is, well, go knock yourself out. But this is actually the second highest peak in household debt income ratio on record. It's like people saying to me, oh, well, the valuations in the stock market aren't as bad as they were during the dot-com, so don't worry about it. Really, that's what they were saying in 2007, if you remember.
I understand.
So I would say, actually, on a historical basis, household debt is still problematic. More so in Canada, by the way, but it's still a constraint in the United States.